Picture this. Today is Sunday, February 8th, 2026. While most of the world is resting and the major exchanges in New York are closed, a seismic shift is silently occurring in the futures markets. The dollar index, or DXY, has officially fractured below the 97-point mark. This is not a technical correction. This is a confession by the monetary system. And the number that is making central bankers sweat cold right now is this. Silver is pricing at $115 an ounce. But wait, the craziest part is not the metal price. It is the terrifying silence of the stock market. The silver mining stocks are still flat priced as if silver is sitting at $50. I need you to do this right now. Close your entertainment apps and social media tabs. What I am about to reveal is not a prediction. It is mathematical data that has been ignored. This is a wealth transfer event that happens once in a lifetime. Where are you observing the collapse of fiat currency from? New York, London, or Shanghai? Let me know in the comments below. Let us perform an autopsy on the current market valuation to understand why the mining sector is currently the most mispriced asset class on the planet. We must ignore the flashing red and green lights of the stock tickers and look directly at the operational mathematics. This is where the forensic analysis begins. And this is where the disparity becomes screamingly obvious to anyone who can do basic arithmetic. The market is currently suffering from a severe case of cognitive dissonance. It sees silver trading at $115 an ounce. Yet it prices the companies that extract this metal as if the price were still $50. Why is this happening? It is because the average investor, and indeed the algorithmic trading bots that dominate Wall Street, are programmed to believe in mean reversion. They are betting that this price spike is a temporary anomaly, a bubble that will burst and send silver crashing back down to $30. They are paralyzed by the fear of buying the top. They are terrified of a pullback, but they are missing the fundamental structural shift in the profit mechanics. Let us break down the leverage of a silver miner. This is the secret weapon of the resource sector. Go back 2 years. Picture a standard primary silver miner. At that time, silver was trading at roughly $30 an ounce. For this company to pull 1 ounce of silver out of the ground, to blast the rock, crush it, process it, refine it, and pay their staff, it cost them roughly $20. This is what we call the all-in sustaining cost. So, at $30 revenue and $20 cost, the miner made a profit of $10 per ounce. That is a 33% profit margin. It is a decent business, but nothing spectacular. Now, fast forward to our current reality with silver at $115. The skeptics will argue that inflation has driven up the cost of mining. They will say that diesel for the trucks is more expensive, that labor unions are demanding higher wages, and that steel for the grinding balls has gone up. And they are right. Costs have risen. Let us be generous to the skeptics and assume that the cost to mine that same ounce of silver has jumped from $20 to $25. That is a 25% increase in costs. But look at the revenue side. The price of the product has gone from $30 to $115. That is nearly a fourfold increase. Now, here's the magic number. Revenue is $115. Cost is $25. The profit is now $90 per ounce. Please pause and let that sink in. When silver was at $30, the profit was $10. Now that silver is at $115, the profit is $90. The price of silver went up roughly 4 times, but the profit of the company went up 9 times. This is called operational gearing. It is not linear, it is exponential. Yet, when you look at the stock charts of these mining companies, are they up 900%? No, they might be up 200% or 300%. They are lagging behind the physical reality of their own balance sheets. The market is pricing these stocks based on the fear of a crash, rather than the reality of the cash flow. This disconnect creates a vacuum that will be filled by a violent repricing event. Investors are sitting on the sidelines, waiting for silver to drop back to $80 or $70 so they can buy the dip. They are looking at charts from 2011 or 1980, thinking that history will repeat itself with a massive crash, but they are failing to analyze the nature of this rally. This is not a speculative mania driven by leverage on the COMEX futures market. This is not a group of brothers trying to corner the market. This is a currency event. The rise to $115 is not because silver has suddenly become more valuable relative to other goods. It is because the denominator, the United States dollar, is losing its structural integrity. The purchasing power of the currency is evaporating, and silver is merely acting as the thermometer measuring the fever of the dying system. Therefore, the cost structure of these mining companies is locked in fiat currency terms while their product is repricing in monetary terms. This creates a margin expansion that is unprecedented. Think about the quarterly earnings reports that are about to be released. These mining companies are going to report cash flows that make the technology sector look like a joke. They will be sitting on piles of cash so large they will not know what to do with it. They will pay down all their debt. They will initiate massive stock buybacks. They will issue dividends that yield 10, 15, or even 20% relative to their current stock prices. And when those earnings reports hit the wire, the algorithms will malfunction. The quantitative funds that look for value and yield will have no choice but to flood into this tiny sector. The pension funds, desperate for any asset that can beat real inflation, will be forced to allocate capital here. But here's the problem. The door is too small. The total market capitalization of all the primary silver miners in the world is less than the valuation of a single mid-tier technology stock. When billions of dollars of institutional capital try to squeeze into this sector to chase those $90 profit margins, there will be no sellers. Who would sell a company that is printing money at this rate? The result will not be a gradual rise. It will be a vertical line. It will be a gap-up opening where the stock price doubles overnight because there are simply no shares available to buy at the old prices. We are currently in the disbelief phase of the market cycle. This is the most dangerous phase for the uninformed, but the most profitable phase for the insider. The crowd believes the price is fake. They believe it is manipulated. They believe the government will step in and confiscate it. They create 1,000 reasons not to buy, paralyzed by the trauma of the past bear market. Meanwhile, the smart money, the silent observers who understand the math I just laid out, are accumulating every share they can find. They're not looking at the nominal price of the stock. They're looking at the price-to-earnings ratio based on future earnings, which is currently sitting at historic lows. You must understand that mining is a depleting business. Every ounce you take out of the ground is gone forever. Usually, the market punishes this. But in a hyperinflationary environment or a currency reset environment, the unmined reserves in the ground become the most valuable asset on the balance sheet. The market is currently assigning almost zero value to the silver that is still in the ground. They are only valuing the cash flow of today. When the realization hits that the dollar is not coming back, the market will begin to price in the reserves. They will calculate how many ounces of silver the company has in the ground, multiply it by $115, and rewrite the valuation of the company. That is, when you see the 10 baggers and the 20 baggers, we are standing on the precipice of this realization. The math is irrefutable. The margins have expanded by nearly 1,000%, but the share prices are stuck in the past. This anomaly cannot exist forever. It is a mathematical impossibility. The gap must close, and it will close by the share prices rocketing upward to meet the reality of the metal price. Do not be distracted by the daily volatility. Do not panic if silver drops $5 tomorrow. It is irrelevant noise. Focus on the margin. Focus on the spread between the cost of production and the selling price. That spread is the widowmaker for the shorts and the fortune maker for the longs. To understand the magnitude of the trap that the global markets have walked into, we must first dismantle a common misconception. Wall Street treats all commodities as if they are the same asset class. They put wheat, corn, oil, copper, and silver into the same basket. They assume that the laws of supply and demand work instantly and efficiently across the board. If the price goes up, supply will appear. If the price goes down, supply will vanish. This assumption is fatally flawed when applied to silver. And this flaw is the reason why the price is currently sitting at $115 instead of $30. Let us look at the agricultural model first. This is what economists call elastic supply. Imagine a farmer in the American Midwest. He grows corn and soybeans. Suddenly, due to a drought in Ukraine or a trade war, the price of wheat triples. The farmer looks at the futures market on his computer screen. He sees that wheat is now the most profitable crop to grow. What does he do? It is simple. Next season, he plants fewer soybeans and plants more wheat. Within 6 to 9 months, a massive new supply of wheat hits the global market. The shortage is resolved. The price crashes back down. The cure for high prices is high prices. This is the efficient market hypothesis in action. Now try to apply that logic to a silver miner. The price of silver has just gone vertical. It is trading at triple its old highs. The profit margins are screaming expand production. The CEO of the mining company slams his fist on the table and demands more silver. He tells his geologists to find more. He tells his engineers to dig faster. But geology does not care about the spot price. You cannot plant silver. You cannot synthesize it in a lab for industrial scale. You have to find it. And here is the brutal truth that the market is ignoring. We have already found all the easy silver. The low-hanging fruit was picked 50 years ago. The great veins of Posse and the Comstock lode are history. Today, miners are scratching at the Earth's crust, processing tons of rock to extract mere grams of metal. The ore grades are collapsing. Every year we have to move more earth to get the same amount of silver. It is a battle against thermodynamics, and we are losing. Even if a company gets lucky and discovers a massive new deposit tomorrow, do you know how long it takes to turn that discovery into a producing mine? It is not 6 months like the wheat farmer. It is not even 2 years. The average lead time from discovery to first pour is now over 10 years. Think about that. 10 years of permitting, environmental impact studies, negotiating with local governments, securing water rights, building infrastructure in remote mountains. sinking shafts, and constructing processing plants. So when the price hits $115 today, the supply response will not arrive until the year 2036. For the next decade, there is no cavalry coming over the hill. The supply is fixed. In fact, it might even shrink. This brings us to the second part of the trap, the byproduct paradox. 70% of the world's silver comes as a byproduct of mining for other metals, specifically copper, lead, and zinc. A copper mine does not care about the price of silver, it cares about the price of copper. If we enter a global economic slowdown, which is highly probable, given the state of the debt markets, the demand for copper and zinc will fall. Copper mines will scale back production or close entirely. When a copper mine closes, the silver that comes out of it disappears from the market. It does not matter if silver is trading at $500 an ounce. If the copper mine is not running, the silver stays in the ground. This creates a terrifying scenario for the industrial users of silver. We could see a situation where the price of silver is skyrocketing, signaling a desperate need for more metal, but the actual supply is falling because the base metal economy is contracting. This is the definition of a supply squeeze. It is a mechanism that Wall Street cannot model because it breaks the fundamental assumptions of their pricing algorithms. They have programmed their systems to expect that high prices bring more supply. But in the case of silver, high prices might coincide with less supply. The market is being set up for a shock that will rewrite textbooks. And the investors who position themselves ahead of this realization will experience wealth transfers that seem almost fictional. The mining stocks are not just undervalued. They are mispriced by orders of magnitude. When this correction happens, it will not be a smooth 20% gain over a year. It will be a parabolic explosion that leaves the unprepared scrambling to chase. The time to act is not when the headlines confirm what I'm telling you. The time to act is now, while the crowd is still in denial, while they are still waiting for the crash that will never come, while they are still analyzing charts from decades ago that have no relevance to the structural breakdown we are witnessing today. Silver at $115 is not a bubble. It is a symptom. It is the market's way of screaming that the monetary system is broken. And the mining companies, with their exponentially expanding profit margins, are the only businesses positioned to capture the value of this breakdown. The mathematics are undeniable. The profit per ounce has gone from $10 to $90. That is a 9x increase, while the stock prices have only moved 2x or 3x. This gap will close. It must close. The only question is whether you will be positioned on the right side of this mathematical certainty when it does. The revaluation is coming. The supply squeeze is real. The profit margins are exploding. And the institutional money has not even arrived yet. When they do arrive, when the pension funds and sovereign wealth funds finally realize what is happening, the door will slam shut. There will be no shares left to buy at reasonable prices. The window of opportunity that exists today will be gone forever. This is not financial advice. This is mathematical observation. This is pattern recognition based on the immutable laws of supply, demand, and profit margins. The silver market is currently experiencing a phenomenon that has never occurred in modern financial history. We are watching a commodity that is simultaneously a monetary metal undergo a repricing, while the extraction industry remains valued as if nothing has changed. It is cognitive dissonance on a massive scale, and it cannot last. The market always corrects, always. The question is not if, but when. And all the signals suggest that when is very soon. Consider what happens when the first major mining company reports earnings that show a 900% year-over-year increase in net profit. The analysts will scramble. The financial media will run headlines. The algorithms will trigger. And within hours, every quantitative fund on Wall Street will be running the same calculation. They will see that these companies are trading at price-to-earnings ratios of 2 or 3, while the broader market trades at 20 or 30. They will see dividend yields that exceed anything available in bonds or blue-chip stocks. And they will buy. They will buy in such volume that the liquidity will evaporate. The bid-ask spreads will widen to absurd levels. Trading will halt multiple times due to circuit breakers. And by the end of that week, the stocks will have doubled or tripled. This is not speculation. This is what happens when institutional capital discovers a mispriced asset with explosive fundamentals. We saw it in uranium stocks in 2023. We saw it in lithium stocks in 2021. We saw it in gold miners in 2020. But what is coming in silver will dwarf all of those moves because the structural setup is far more extreme. The profit margins in silver mining right now are higher than anything we've seen in any commodity in the last 50 years. And the market capitalization of the sector is smaller than it has ever been relative to the size of global capital markets. This is the perfect storm. Now let us talk about what you should be watching for. The first signal will be insider buying. When you start seeing executives and board members of mining companies buying shares in the open market with their own money, that is your confirmation. They have access to the real-time production data. They know exactly what the profit margins look like. And when they are willing to bet their personal wealth on their own stock, you know the numbers are real. The second signal will be merger and acquisition activity. When silver is at $115 and a mining company has proven reserves in the ground, it becomes cheaper for a major to buy the entire company than to try to discover and develop a new mine. We will see hostile takeovers. We will see bidding wars. And each acquisition will establish a new valuation floor for the rest of the sector. This will create a feedback loop that pushes all mining stocks higher. The third signal will be government intervention. When a strategic resource like silver becomes this valuable, nations start to pay attention. We could see export restrictions. We could see nationalization threats. We could see countries offering tax incentives to miners to keep production domestic. All of this will create volatility, but it will also confirm the thesis. Governments do not fight over worthless assets. They fight over the ones that matter. And silver matters now more than ever. It is not just a monetary metal. It is the critical component in solar panels, electric vehicles, 5G infrastructure, and military technology. The green energy transition that every government is pushing requires silver, lots of it. And there is not enough. There has never been enough. And at $115 per ounce, there still will not be enough because supply cannot respond fast enough. This is the final piece of the puzzle. Demand is structural. It is not discretionary. A solar panel manufacturer cannot decide to use less silver because the price went up. The technology requires a specific amount. They either pay the price or they stop production. Governments have mandated that green energy production must increase, so the demand is locked in, it is guaranteed, it is non-negotiable. You are watching the collision of inelastic supply and inelastic demand. Economics textbooks will study this moment for decades, and the people who recognized it early will be the ones who capture the generational wealth transfer. So what should you do? First, educate yourself. Do not take my word for it. Go look at the financial statements of the major silver miners. Look at their all-in sustaining costs. Look at their reserve reports. Do the math yourself. Calculate what their earnings will be if silver stays at $115. Then look at their current stock price and ask yourself if it makes sense. Second, ignore the noise. The financial media will tell you that silver is in a bubble. They will interview experts who predict a crash. They will show you charts that compare this to 1980 or 2011. None of it is relevant. This is a different world. This is a different monetary environment. This is a different supply and demand structure. The past is not a guide to what is happening now. Third, think long term. This is not a trade. This is not something you buy today and sell next week. This is a position you hold while the world reprices an entire asset class. There will be volatility. There will be pullbacks. There will be moments when you question everything. But if the fundamentals have not changed, if silver is still at $100 or $120 or $150, and if the mining companies are still printing cash, then nothing has changed. Hold your position. And finally, share this information. If you found value in this analysis, if the mathematics made sense to you, then share this video with someone who needs to hear it. Subscribe to this channel so you do not miss the updates as this situation develops. Hit the like button if you want to see more deep dives into the markets that mainstream media refuses to cover honestly. We are living through a historic moment. The greatest wealth transfer in modern history is unfolding right now. The question is whether you will participate or whether you will watch from the sidelines and regret it later. The data is clear. The math is undeniable. The opportunity is now. Do not let fear or disbelief rob you of what could be the most important financial decision of your life. The silver market is about to shock the world. Make sure you are ready.